the recording. So as you guys know, we are recording at this time for your viewing pleasure. So here's the thing. We basically, I'm going to do kind of a little bit of a sit rep. Sorry, excuse me, before we begin. One of the things that I wanted to do is, and I'm trying to remember, the problem is I couldn't find it when I was looking at my emails last night. Did I actually send you guys the emails with the videos that we did last week?
I don't think so, Professor.
I don't think so. Okay. So what I will do when I get done with class today, I'll upload today's video and then I'll send out an email that basically has a link to all the videos. So that way, when you guys are going through the exam, if you're like, I just don't remember what we said about this, maybe it helps out and maybe it doesn't. I don't know. I found out that in second of all, I'm looking for some feedback. I had a couple discussions with some professors. Probably, I think it was, yeah, actually, yeah, it was yesterday. So yeah, it was only yesterday. It feels like it was forever ago. So did, it sounds like are professors putting these videos on Blackboard for your guys' viewing pleasure, and then that way you guys can just take a look at it whenever, or are they doing the YouTube thing like I am? All yours have been on Blackboard. Okay, they're totally okay. Yeah, I might have to move towards that with my next class for this spring summer. The only reason why I'm kind of bringing that up is the well, the main reason why I'm bringing it up is I didn't, first of all, I've not been using Blackboard Collaborate. As you can tell, I've got, like I said, I've been using the YouTube thing. I didn't know if it's a better platform or if you feel that Blackboard is. I'm almost afraid to even ask for, I'm almost even afraid to ask for what's your viewing pleasure on that. You guys are probably going to be like, well, Blackboard would probably be better just because we're always going there anyways. And I'm sorry that if that caused any issues. Oh, you think it's bad? Okay. Oh, it has. Oh, I did not know that. Okay. Yeah, it's actually funny, Zach. And if you guys aren't seeing it, Zach said he thinks it's better. YouTube's better because Blackboard's had issues. It's funny that you say that because my son, he's a student at Thomas Jefferson. Obviously a lot smarter than his father will ever be, but and don't tell him I said that. He's 15 years old. He's got a big enough ego on his own. But the fact is that he's been saying that the Fairfax County public school system's been really struggling with their online content presentation. So maybe it is better. Okay, then in that case, and I'll continue to use the YouTube thing, then that would probably be best. If anybody's got any other feedback to provide for that, please feel free to chime in. I'm very happy to receive that because, here's the thing, folks. Everybody, I know the main goal that everybody has in this room is what? It's the primary goal is to get the sheepskin so that you guys can go, so that you guys can work, get the nice job after you leave the university. And for those of you who are English is not your first language, the sheepskin in the good old days when you used to get the degree, you didn't actually get it on paper. It used to be actually done on sheepskin, and that's why sometimes when they refer to college degrees, they call them sheepskins. Of course, nowadays they're all on paper, but the thing is that in order to get your degree, that's usually the main goal that a lot of people have. Now, my personal opinion is, if I'm going to pay a lot of money for something, I better get something out of it. And so that's why it's very important for me to deliver the product to you guys that you feel that you need. But at the same time, and look, I hate to say it, I'm trying to say this without sounding condescending. There's going to be some times where you guys maybe don't necessarily know what you need. And it's my job to, and I'm trying to approach this as, I'm sitting in my office. All you can see is the wall. Actually, this is not a very good shot because it doesn't look very dignified as an office. But I'm sitting on the desk of my own company, where I've got the king size desk with the king size desk. I mean, the employees talk about how big my desk is. Um, and I'm looking at it saying, look, if you were outside sitting in one of my staff cubicles out here, what would I expect you to need? What would I expect you to know in order to be able to perform your job to the best of your ability? And that's how I've always tried to approach this class. And I hope that I've meet those expectations. The bad news is, I think a lot of you are going to know whether I've met those expectations or not within the first 2 to 3 years of your accounting career. And of course, the most important thing is we got to have fun. If we're not having fun, life is too short to just sit around and be bored all the time. So I know some of you are taking tax because you guys, it's a requirement in order to get the degree. Some of you guys are going to be like, I'm going to go be an auditor. And I've always made jokes about the fact that, if you want to be an auditor, you just don't know what you're doing. Tax is cool. We're the place where you, and I'm going to tell you something, and money's not the most important thing. I know that sounds like a very egalitarian or a very collegiate type thing to say. Well, money's not that important. It's not, when you have the money, it's always nice to say that, right? But the most important thing is that you do what you love and that you're very passionate about what you do, because if you're going to spend eight hours of your day doing something, it better be something you enjoy doing, because if you don't enjoy doing it, eventually what's going to happen is you're going to be 40 years old buying a sports car when you're losing all your hair. And for ladies, you're going to be trying to figure out what to do to go back to your 20s because you feel like you've wasted your life. Well, because guys do the same thing, actually, other than the fact that, Mother Nature has basically made sure that I will never go back to my 20s. But the thing is that, my goal is to just give that to you. So today, and I'll kind of get off my soapbox now. Today, we're going to talk about S corporations. Thursday is the official day where we actually talk about the test. I'm also going to announce right now, on Thursday at 4 o'clock, which will be this May 7th. So for May 7th at 4 o'clock, I will be having office hours for your class. Now, that doesn't mean that somebody from 781 won't show up, but the main topic of the day for that will be your stuff. 781's office hours will be 1 hour later. You guys can ask me any questions at any time during that time, but the priority will be those specific classes. So at 4 o'clock, it's you guys at 351. 781 will be at 5 o'clock. But if for some reason you can't make it to the 4 o'clock session, what we're going to try to do is I'm going to try to get the important stuff knocked out within 30 minutes, and then kind of leave the next 30 minutes sort of as a free-for-all where anybody can ask any questions that they have. I'm just going to offer that to anybody, and if you've got any questions about it, or if Thursdays are a horrible day for anyone, please let me know, and I'll see if there's a way that I can do an alternate timeline for that. But Thursday at 4 o'clock, we did that in the past. We had a pretty good turnout, and so I'm just going to go ahead and offer it to you guys. I don't know what the job situation is for everybody, and I don't want to ask this on an open forum. But at the same time, I hope that, if for some reason you're not able to go outside and work, spend all this time getting to be really good at what you're doing. And my personal opinion is start studying for the CPA exam. Use this downtime as much as you can. I don't know how close you are to being able to take the exam. And as I recall, I know DC, and I think Virginia does too, they allow you to start taking the exam if you have at least 120 hours. So if you're seniors and you're about to graduate, my personal opinion would have been to have spent these past few weeks studying for your first part of that CPA exam and get that done. Because as I've said in the past, there's three things you need to be very successful. If you want to rise to the top of one of some of these local firms eventually, there's three things that you have that if you have under your belt, you're going to just nail it out. Number one is that you have your master's degree in whatever discipline you are. If you're an auditor, master's in accounting is important. If you're a tax person, my opinion, the master's in tax is more important. If you are, number two, you got to have your CPA. They will not, most places will not even consider you for a management position without your CPA, unless you've got Big Four experience and the Big Four didn't require you to have it for whatever job you do. So, for example, I worked at Global Mobility Services. CPAs were not required. As long as you were certified either a CPA, EA, or a tax attorney, they were happy with whatever you had. And so as a result of that, what would end up happening is that you would be considered quote unquote certified if you had any one of those three designations. Now, if you worked at the Big Four for 10, 15 years and you want to go work as a director at a local firm, and all you have is your EA, what they'll do is they'll bring you in under a special exception to policy, but you'll never make partner. Okay. The third thing that you really need is you need some famous experience. Whether that's, I did, 3 years at, KPMG. I did 3 years at PwC or Deloitte or whatever. Big Four is helpful, but it's not necessarily Big Four. I've talked to some people who felt that, at the local firm level, at least, as long as you had, Big Four, BDO, Grant Thornton, or even Dixon Hughes Goodman, they usually found out that their careers were pretty satisfying because, having that big name, or Baker Tilly is another good one. CLA is another one. If you've got somebody that's kind of a big name firm that you've actually worked at in the past, obviously the further down you get to that, the less powerful it is. But here's the thing: if you want to be successful in the accounting industry, you don't necessarily have to do it and be at KPMG the whole time of your entire career. You just got to punch a ticket. And we call these in the industry, we call these ticket punchers. Once you've done your ticket punchers, like I said, once you nail those big three, I mean, I've been in talks with minimum 7 or 8 firms just in the past year alone that have talked about, hey, Kevin, let's bring you on board. We want to bring you in. We want to make you a partner. Blah blah blah, so on and so forth. Because I've had those experiences. So. Anyways, that's all I got to say about that, and we'll talk about S corporation. So today we're going to talk about S corps, and so as we talked about in the past, this will not be on the exam. That said, I think that there's a few things. I mean, there's a couple things where we did mention S corps. The S corp questions that I put on the exam were limited to anything that was in, I believe, Chapter 15. Chapter 15, which is sort of the basic overview of all organizations. They did have some varying characteristics. Now, I think that after you get done with this S corp, you're going to be able to answer the questions that are on the test. So it's going to help you. But when I wrote these questions, I never went to Chapter 22. Okay, everything that I went to, I looked, and here I'm be honest, and some of you are going to know this just by looking at some of the questions. What I did is that I went to Chapter 13. I went to the questions in the back, and I said, okay, I'm going to take these questions. I want to modify it the way I want it, and that's what I'm going to put out. So I went to each one of the chapters and kind of did that. Now the first 5 or 6 questions were kind of me pulling things out of the air, the stuff I've seen in the industry that I think people should have a better understanding of. And there's an old saying we have in the military, and that's regulations are written in blood. And that's not to suggest that we're all gory individuals, but usually somebody gets hurt or dies, and as a result of which they make a new rule to make sure it never happens again. And so, oftentimes, when I'm writing my tests are written in blood because it may be something that we run into in the past, and I'm just like, holy smokes, I wish somebody had talked to me about this before that. Now, it's impossible for me to figure out every contingency for anything that you've got, but at least it gives you some real world experience so that you're not looking at this going, why does this matter to me? Everything that I put on my exams is usually something I've had to deal with at some point in my career. So if you take a look at something and kind of scratch your head saying, what's the significance of this? Don't worry about it. Maybe it won't help you. But for the most part, it's something I've run into, and I've had a pretty varied career, so I've got it. Anyways, back to S corps. So these are going to be the learning objectives. The first thing we're going to talk about in the S corporation is the formation. Now, when we talked about this under C corporations, we kind of talked a little bit about 351. I don't think we really got too much far into it. And I was doing some digging for the class today, and one thing that I kind of noticed, this is actually very interesting. Now, we talked about in the past, when you are, when we're talking about precedence of the rules. So first of all, we talked about, the number one on precedence is tax treaty. So if we sign a tax treaty with another country, that's going to take precedence over our law. And now that sounds kind of counterintuitive to everything we've learned in history, or I'm sorry, civics class. Because when I was in civics class, Constitution is ultimate law of the land, or supreme law of the land. The thing that you have to understand is that's true, but the Constitution also provides that we can enter into treaties with other countries. Now, we hopefully, and again, I don't know, I don't have a whole lot of faith, lately. And when I say lately, I'm talking, the last 10, 15 years, that we're always going to enter into treaties that do everything that's for the best benefit of everybody. I tend to be a skeptic, but the thing is that when you do enter into treaties, you are agreeing that you're going to abide by a certain set of rules, regardless of whether you want to or not. But that's you're freely to go in and out. So that's why it's at the top. Then you have U.S. Constitution, and then you have the law, which is, of course, for us, Title 26, which is the law. And then you have revenue. Then you have regulations, and then there's a few other things. Well, one of the other ones that they have is this thing called a revenue ruling. And we've talked about a little bit about revenue rulings, and a revenue ruling is basically just something, and here's the thing. Usually revenue rulings are things that the IRS is seeing a lot of, and they figure that, some of the stuff that's out there may not be clear enough for people to be able to understand it. Now, the funny thing about 351's been around for years. I mean, it's been around longer than I have. And I'm 45, and 1 month to go, actually less than 1 month to go to make it to 46. This to me is my what I would call my unlucky year. I was kind of worried about 45. I figure if I made it to 46, everything would go great afterwards. But one of the things that that 351 has done, 351 has gone through a lot of case law. It's gone through a lot. I mean, it's gone through a lot. So what's happened is that people have gotten to the point where, Section 351 is pretty, is pretty well defined law. Now, if you go take a look at Code Section 351, it's a boring read. I was digging around, and I found this revenue ruling, 2003-51. So as you know, revenue rulings are, or you may not know, revenue rulings are basically numbered the year and then the number of the ruling that's come out. So this is rule number 51, or ruling number 51 that came out in 2003. So it says, and so the issue that they came up with is whether an asset of transfer of assets of a corporation exchanged for an amount of stock in the first corporation constituting controlling satisfies the control requirements of 351 if pursuant to a binding agreement entered in by the transfer with a third party to exchange or transfer the stock simultaneously with the transfer of basis of assets by the third company. So what's happened here is this is an issue that they probably ran into. There's a possibility that this all went all the way to tax court, and the IRS may have settled out of tax court for it. And one of the reasons why they may have settled outside of tax court for it is they realized that there was enough gray area that if it went to a judge, it could blow the whole thing up. So they decided, and again, I don't know the particulars of this case. I'm just saying, and this is kind of me hypothesizing, but it's possible that somebody at the IRS ran into this and said, look, we need to solidify this sort of thing because this kind of came up and almost burned us. Now, that's an entire possibility. The other thing is that, somebody may have brought this up for public comment. And the IRS looked at it and said, we're going to issue a private letter ruling to you in order to handle your transaction. And then we're going to go out and we're going to develop a revenue ruling in order to answer this for the general public at large, because there's a greater good component of this. Now, you might say, well, gosh, Kevin, why would they use a revenue ruling instead of a regulation? Couldn't they just make, regulation 1.351-10? Because I'm sure there's probably a whole bunch of regulations on 351. And the answer to that really is time. Um, the thing that you have to understand is that regulations usually require about 18 months to propagate, and then they have to go through comment periods, and then they have to go through this huge process before they become finalized. An actual revenue ruling can actually take 6 months. So somebody probably looked at this and said, instead of doing a whole, or maybe they said the regulations are already well developed to answer this question. We just don't think people are answering it the way that we would like them to answer it. And so we're going to do this kind of sort of to plug the gap. And so sometimes that's why they'll do this. And so they've given you these facts as part of this where they've said, domestic corporation engages in the business, blah, blah, fair market value of the businesses of A, B, and C, and so this is usually setting up a pretty interesting dynamic of a particular case of 351. And so I'm bringing, and the reason why I'm bringing this up, and I know you're probably saying, gosh, Kevin, what does this really have to do what does this have to do with S corps? And the answer, for the most part, oh boy, it's okay. Anyways, I'm going to deal with that later. My computer screen's been acting up lately. And so why do I bring this up is that when most people think of 351, they're always thinking of C corporations. And I think part of the reason for that is when most people envision how an S corporation gets formed, they figure it follows the laws of partnerships. And I've talked about this in the past that I think S corporations are what I call Frankencorps. And I say Frankencorps, not corpse, not because they're dead bodies, but corpse as in corporations, Frankencorporations. It's because you take certain parts of the body, it's like Frankenstein, the big monster from from literature that was made by Dr. Frankenstein. It's almost like somebody at the IRS was playing Dr. Frankenstein and said, we like these aspects of corporations, we like these aspects of partnerships, and they put together this monster through electricity, and next thing you know, it wanders around. And I'll be honest with you, I think S corporations are by far more popular than most other organizations. Now, and I'm talking about from a tax perspective. Obviously, the LLC is by far the most popular organization that usually gets created on a day-to-day basis, and that's just because it's very easy to set one up. But how does the assets get into the corporation is a major question that needs to be answered. And here's actually the funny thing. Most people think it works just like a partnership, but actually it doesn't. It follows the exact same rules as C corporations, which is 351. And the way it works is if I transfer all of my assets into the organization, all the assets I'm going to into the organization, and say there's 3 of us that are going to do this, and we're starting an organization, and we've decided that we want to transfer assets into this corporation in exchange for stock. Without 351, if I were to say for example, I transfer in my car, and we'll say that my car, instead of being a nice 2014 Camry, the luxury version, instead of it being that, we'll say that it's an old Mustang from 1966. Obviously worth a lot more than it was when I first bought it. Okay, because it's a classic. I would have to recognize capital gain by giving that car to the corporation in exchange for stock, because basically what it would be is it would be a non-like kind exchange. Code Section 351 provides that everybody will have an opportunity to put those assets into the corporation in exchange for stock and not pay any gains on it. Now, why did Congress do this? And it did it to facilitate the creation of corporations. And here's the thing: if you had to pay gains on things you contributed to the corporation, who the hell will do this? I mean, this would be ludicrous. Or what we would do is we would tell people, go ahead and form a partnership instead. And then, of course, those have horrible tax consequences in many instances of the business. But Code Section 351 has a few requirements. One of the requirements is the controlling requirement. And they kind of talk a little bit about the controlling requirement down here. And so the law, as they put down here, they say 351 says that no gain or loss shall be recognized if property is transferred to the corporation by one or more persons solely in exchange for stock of said corporation, and immediately after the exchange of such person or persons are in control of the corporation. In other words, the three of us contributing assets in exchange for stock, we must now control that corporation afterwards. Now, what is control defined as? Control, under Code Section 368, subsection C, defines control of ownership of a stock possessing at least 80% of the controlling aspect afterwards. So, for example, there's three of us who decided we're going to do this. I contribute to the corporation. My two buddies contribute to the corporation in exchange for stock. That transaction by itself, 351 covers, because after we contribute to the organization, three of us are in control. We control 100%, 80% met. So later on, say about a year or two later, one of my partners or one of the other shareholders' cousins wants to get in and says, well, I'm going to put $10,000 into the organization. Actually, instead of cash, we'll say it's land. So he puts in land that's valued at $400,000, but only has a basis of $100,000. He puts it in exchange for stock. Well, here's the problem. And say we give him a 20% interest. The only person who's contributing has a 20% interest. 351 will not apply to that individual because they don't meet the 80% total number of shares in the class of the stock. Now, how do we solve this? It's actually there's some tricks that we use in this where we do this where we say, okay, put your land in, and you're going to get this many shares out, and then each one of us is going to go buy one share of stock. So I buy a share of stock. My two other shareholder partners buy one share of stock, and then he makes his contribution. And by doing that, we have 100% of control after the contribution takes place. And some of you might say, wow, that seems like kind of funny lawyering business. Well, welcome to the world, folks. That's what we do. When we have clients who come to us and say, look, we want to do a 351 exchange by bringing in a new partner or new co-shareholder, usually we end up trying to structure the transactions in a way that allows us to get around it. So yeah. So this says, so, and here's the other thing that's kind of interesting about 351. The transaction doesn't have to happen immediately. It says Section 351A, -1A1 of the income tax regulations, immediately after the exchange does not necessarily require simultaneous exchanges by two or more individuals. But comprehends a situation where the rights of the parties have been previously defined in execution of agreement. In other words, if we go ahead and make an agreement that says, look, we're going to go ahead and we're going to execute this, and we'll say within 6 months, this is going to get executed. So I contribute my cash, the other person contributes his cash. Person number 3 who's contributing, say, inventory, he has to settle with some insurance obligations on that. So it's going to take him a couple months to get things wrapped up. Maybe it doesn't happen immediately afterwards, and it doesn't have to. But because he's already signed an agreement saying, I'm going to contribute this inventory in order to get my shares, that's good enough. Okay. Now, by bringing the cousin in 2 years later, he's not part of that original agreement. We can't go back and modify that agreement just to satisfy 351. We're going to have to do another agreement. So the courts are pretty, are pretty well ruled on this. As you can see here, there's actually this rule right here, just talking about this one thing, references 1, 2, 3 court cases, and then they also reference 1, 2, 3, 4, 5. I'm sorry, 1. Go back. 1, 2, 3 revenue rulings. So there's plenty of information out there on 351, and it's actually a good thing. And some of you might just say, oh, well, Code Section 351, contribute everything, 80% control, everything's fine. That seems to be the thick black line. That's not the case, folks. There's a lot of people, and I'm telling you right now, and this happens for C corporations, S corporations, and partnerships. The biggest problem we have in audits is usually owner-entity relationships, okay? And 351 falls into that group. I would say we go through a lot of auditing and arguing with the IRS simply based off of 351, or not 351, but owner-entity relationships, and that's what usually ends up causing a lot of this. All right, qualification requirements, we've done it. Qualification requirements of the S corporation. So S corporation type and number. So usually it has to be individuals. Now, there's an exception to this, and you could do what's called a QSST, which is a qualified S corporation trust. And I'll talk a little bit about why we would want to do that here later on. But generally speaking, it has to be an individual, and you can have no more than 100 shareholders. Now, 100 shareholders is the key number. It will probably be on your CPA exam. It won't be on my test because I told you we wouldn't cover that here. But you definitely want to make sure that with your numbers you don't bust that 100. Now, 100 people is defined. Husbands and wives are considered one shareholder. So if I have, me and my wife own, if I own 50% of Beta Solutions, she owns 50% of Beta Solutions, technically under the rules, we have one shareholder. And so that usually ends up causing some, it can change the math. You think about it, theoretically, if I have married couples that are going to be owners of the company, I could have 200 people involved and not bust the 100 shareholder rule. So that's going to be, and like I said, limits on corporation type. Generally speaking, I'm not going to talk too much about this, but the one class of stock is probably the bigger issue that we run into. Now, like I said, and actually before I talk about that, the QSST, one reason why we would want to do a QSST, another requirement of the shareholder type is that you must be a U.S. tax resident. Now, I did not say citizen, and I did not say green card holder. I said you must be a U.S. tax resident in order to qualify for this. What does that mean? You have to have a Social Security number. In other words, we have to be able to tax you legally in our jurisdiction. And that kind of makes sense because if we're going to make you an owner of an S corporation, that's going to have flow through, so it doesn't get taxed at the entity level, but instead gets taxed at the individual level. That individual doesn't have a legal. If we don't have a legal, well, if there's no legal requirement for that person to satisfy a U.S. tax obligation, technically they could just walk away and never pay any tax, and the IRS isn't going to allow that to happen. If you did that, you'd hear a giant sucking sound of everybody trying to leave the United States owning S corporations so they could avoid tax. That's not what the IRS wants to do here. So they've made it to where if you're a non-U.S. tax resident, you cannot own an S corporation. If you do, you're going to bust the S election. You're going to revert to a C election like that. So you want to make sure that you don't bust that. The one class of stock, because it's got the flow-through opportunities to do stuff, and in order to make the math easy, the IRS has pretty much said you can't have more than one class of stock. And so basically, if you as a corporation, if you decide to issue out preferred shares, you're busted. You're done. There's nothing you can do. Or if you decide to say we have A shares and then we have B shares, you're busted. Can't do anything. And it doesn't even matter whether it's attached to voting rights or not. If you say, well, we're going to have one class of stock that has all the voting power and one class of stock that doesn't have any voting power, they're going to basically tell you, sorry, you busted the election. You're done. And so you don't want to have that happen. If it does happen, you're going to revert to a C corporation very quickly. Filing the election, you're going to file the election on 2553. The Form 2553 basically says, I want to be taxed as an S corporation. It requires a signature of the head of the organization, but also requires a signature of each and every single person who's going to be a shareholder in that S corporation. One person refuses to sign, you don't have an election. It won't happen. And then the effective date. Generally speaking, if you want to follow the rules, you're supposed to file this S election within 2.5 months of the tax year in question. So in theory, say for example, I formed the organization on January 1st, and I want it, I would have until March 15th to file that. Now, if I form it and it's a calendar year, say in July 1st, but it's a calendar, we're going to have a shortened year. You have 2.5 months from the date of that formation. So if I form it, say for example, July 1st, I would have 2.5 months later. So I had to basically have until September 15th to make that election in order to follow the rules. Now, the IRS will allow you to go back as far as 2 years. I think it's like 2 years and 7, they have like some weird calculation that goes along with it, but it's almost 2 years into the past. If you can request a late S election, and the IRS is actually very generous with this. They'll grant you a late S election, and they're usually pretty accepting of them. I mean, I've probably done about 40 of them, and almost every single one of them are late. I even had one that was late, and it was late more than the period that they did, but we actually did it through what's called a PLR. We did a private letter ruling requesting all of that. Now, it cost the client somewhere in the neighborhood of around $8,000 to do, but she ended up saving $25,000 in taxes as a result of it. So she was very eager to do this and get it done. The $8,000, 2 of it went to the IRS and 6 went to me. So it was one of those things that we ended up doing. Now, some of you might say, "Wow, $6,000 for that for just filing a letter? That sounds like great profitability." I can't tell you the number of hours I spent on this. Arguing back and forth with people, trying to get the prior CPA, trying to get them to admit that they screwed up, which was hard. Because of course they don't want anything out there that they screwed up. But at the same time, they provided emails that they had with the stuff. I don't think they gave us 100%, but anyways, it is what it is. So that's kind of what's going on with the S corporation stuff. We're gonna, like I said, we're gonna go ahead and skip some of that stuff. The voluntary terminations, the elected by shareholders with more than 50% of the stock. So if more than 50% of your shareholders decide after the S election is done, we don't want to be an S election anymore, it's gone, done. Usually it'll happen at a shareholder meeting, and then there will be an established effective date of that to take place. Normally that's done by board meeting presidents. This is why board meeting notes are critical in an audit. You want to make sure that you're keeping those. Now, in my case, where Beta Solutions has one shareholder, I'm not going to walk into the conference room and talk to myself for a while. Although I actually may have a board, and I've actually talked to people about this. Hey, I'm going to run Beta Solutions, and I'm thinking about having a board of directors. Would you like to be on it? And I thought about doing that just so that I can get some people that I respect in the industry to kind of give me some guidance on some stuff. But an advisory board of sorts, but generally speaking, your board of directors is going to be owners. Like I said, election by shareholders, 50% or more, effective date whenever they've gone and done it. Now, the involuntary terminations will happen if you say, for example, you decide to give shares to somebody from, I'll just pick a country at random, Thailand. Well, guess what? By handing that to a Thai citizen who has no tax jurisdiction, there's no jurisdiction to tax them in the United States, you've busted your S election. Passive investment income in excess of 25% of gross receipts for 3 years. The IRS does not want S corporations to be used for rental activities, and it's kind of funny. I actually ran into I had a client who basically did this, and I told them, I had to warn them that they were going to lose their S election if they did it for more than 3 years. So, for example, I'm trying to think of a good example. Oh, good example, McDonald's. I don't know if you've ever seen the movie about Ray Kroger. Ray Kroc, the guy who was basically seen as the founder of McDonald's. It was actually a very interesting movie, and one of the lines in the movie is, where somebody was telling Ray, "Hey, I think you're making a mistake here. You don't know what business you're in. You think you're in the hamburger business, but you're not. You're in the real estate business." And it was kind of the thing for him, because that's when he started it to where when you buy a McDonald's, they would actually buy the land that the McDonald's would actually sit on, and that way they would have a controlling interest in keeping you viable. And then you would also have to listen to them because they're the landlords. They could kick you off the land, and then you lose your store. So that's something that they do. Now, in his case, because they're obviously, if they have it as and I think the way McDonald's does it is that it's structured as It's structured as a separate organization that does all the real estate. But pretend for a moment there that it was an S corporation. It's obviously not, because McDonald's is a publicly traded company. It can't be an S corp. But if it was an S corporation, they would have to be able to elect out of the passive income category for this, and there's a way for them to do that by being a real estate company. But again, if you're doing more than 25% of your gross receipts for 3 years, what ends up happening is that you will actually lose your S election involuntarily. They've got some short tax years. We're not going to talk too much about this because this doesn't happen very often. If it does, my recommendation is look up the rules. The S corporation re-elections. So this was actually a very big. Actually, it's very fascinating. I was having a conversation with somebody about this last year. Not last year, but yesterday. Generally it's available at the beginning of the 5th year after termination. So if you're an S corporation, you decide to terminate and go to C corporation status, you have to wait 5 years before you can before you can reactivate your S election. Now, this was a major conversation here about 2 years ago, in the industry, because what ended up happening is a lot of CPAs were because when they dropped the corporate tax rates from 35 to 21%, a lot of people were like, holy smokes, I need to consider moving my guy from S corporation to C corporation so they pay lower taxes. And in fact, that's what the problem I was having with my guy that I was working on. He owes a lot. This guy that I have, the client that I have is looking at about a $4 million profit, and he just set up his company. So the question that he asked me is, do I want to be an S corp or a C corp? And I'm like, you want to be a C corp, pay 21% of your profits. And he's like, yeah, but don't I have to deal with double taxation? Yeah, that may be true, but there's ways we can get around that so that you can get around some of the double taxation by paying yourself a salary, or and reducing that overall tax effect on that. My personal opinion is, it turns into an additional pit of money for him that he can actually make some money off of. And these are just going to be a few deals that he's going to be doing. And then what will end up happening is that he'll, it'll probably turn into a company that he can then retire off of. And so that's kind of what he's looking for. Now, the IRS will grant early consent on this. I've not heard too many people who've been successful with this. I would anticipate and pretend for a few minutes that the Democrats control the Senate, the House, and the White House as of day one in January after this election. I think one of the biggest targets that they're going to have is to take that corporate tax rate and take it from 21% back to 35% where it was. And that's just in talking to some of my friends who work on the Hill for Democrat congressmen. Now, it may take 2 years for them to do it, but say, for example, they do it in 1 year. All those people who elected C status are now going to want to do this huge sucking sound of requesting the IRS to go back to S status pronto. I would anticipate that if that were to take place, you're going to see a lot of people doing early consents. So it is possible you're going to have to know this, the procedure to do this, when you go work at the accounting firm, because you may be working on some of that stuff. So like we said, accounting methods, and this is all same stuff that we've talked about in the past. It's elected at the entity level. Methods carry over from C corporation, may choose cash accrual. It's basically everything the same as a C corporation. Generally speaking, there's not a whole lot of discussion with this. Most of the time, immediacy is usually the driver. Now, if you have more of a strategic view, very good example. My client, that one I was talking to you about, he had a $4 million issue. We were looking into the 4 to 5 year ramifications of doing the C election versus the S election and trying to figure out, because he's an LLC, so we can go either way. We've decided to go ahead with the C election because we're taking a long-term strategic view of things. So there may be, but oftentimes it's, oh my gosh, you got yourself into a transaction. We need to do this like now. And we're just trying to clean up a mess that you created by not talking to us. That could end up happening. And so you can end up running into some trouble with that. So income loss allocation, this is where it starts working more like a partnership. What ends up happening is that profit losses are done per shares. Now, you remember back when we talked about partnerships, there are those three categories. You have profits, losses, and capital. And, capital is basically how much money did you put in. Profit and interest loss, I can give you whatever profit and interest loss I want, and there's no tax consequences. S corporations don't have that. Everything is done by shareholder. So if I go in and say there's 50,000 shares out there and I own 10,000 of those shares, I'm getting 20% of profits and losses, and that's it. There's none of this capital account, all that other stuff. If you take a look at an 1120S, if you take a look at an 1120S, gosh, I can't screen. So you take a look at an 1120S, all this blank space right here that says for IRS use only, that's where they would put all the debt basis stuff. That's where they put all the capital account stuff, all that. All they have here is shareholders' percentage of ownership. That's it. So there's a lot, these 1120S K1s tend to be very clean. They're a little easier, in my opinion. There's not a whole lot of, oh my gosh, what about, and special allocations don't exist. And as a result of special allocations not existing, it kind of makes things a little bit easier in that sense. So anyways, if sell shares during the year, pro rata, pro allocation, yeah, that's true. If all shareholders with changing ownership agree, the S corporation can use its normal accounting rules to allocate income or loss. But yeah, this doesn't happen very often. Generally, it's done by the share of the ownership. I would very rarely would I ever even imagine that this would actually happen. We talked about I just showed you the K1 separately stated issues, just like we do with a partnership. Ordinary business. Notice that box 4 is no longer guaranteed payments. Why? S corporations are required to pay their shareholders via the W-2s. You're an employee of the S corporation as of immediately. And then you have the ordinary dividends, ordinary, qualified dividends. All this stuff is separated. If you took a look at the K1 for the partnership, you'll see a lot of similarities between these. But there's a couple things that you won't see. Number one, there's no box 14 talking about what's your self-employment income and loss. Doesn't matter. S corporations don't pay self-employment income. It's basically income from that. There's no self-employment tax as a result of the S corporation, so there's no box necessary for it. I'm trying to think of what the other major differences are. It's some shifting that ends up happening, but there's only 17 boxes instead of 20 because there's like 3 boxes that are missing. Like I say, guaranteed payments being one of them, box 14 being another one. And I'm trying to think of what the other one is. Yeah, I don't know. Anyways, doesn't matter. But the most important thing is, like I said, these are cleaner. They're a little easier to deal with. And life is pretty good with that. Okay. You guys know about common separately stated items because we've talked about that in the past. Now, basis. How does basis work? Basis with an S corporation actually is pretty easy compared to a partnership basis. First of all, there is no debt basis. There's no debt basis. All it is in the way that it works with an S corporation, cash in, increase in basis, cash out, decrease in basis. Income in, increase in basis, income out, decrease in basis. That's it. There's really not a whole lot more to this. Now, there is one way to get debt basis in an S corporation. It's a little harder. Basically, if I loan money to the S corporation, so when I borrow money from my, if I have $50,000 sitting in my bank account and I want to give it to my S corporation, but I don't want to get shares in exchange for that, but I make it as a debt obligation to the S corporation, that technically becomes debt basis that I have here. And I've seen it where a lot of people try to structure all sorts of different types of debt transactions so they can get that basis. My personal opinion is, it's kind of like, everybody uses so much of their brain power to cheat the system without having the effects of the hits on self-efficacy. For the most part, if we put that brain power to solving problems, I think we'd probably, we'd have a much better world. But again, that's my idealistic side talking. Again, basis of property transferred in, less any liabilities is going to be, this works just like a partnership. You don't have to, there's not really a whole lot of brain power that needs to go into this. if you understand the partnership areas. And that's one reason why we really focus on trying to get you to understand the partnership stuff. If you understand the partnership stuff, figuring out the differences between partnerships and S corps is actually pretty easy, because there's a lot of there's a lot of things we don't have to deal with anymore. You purchase the stock, you're going to increase your basis. Again, cash in, cash out. Cash in, basis up, cash out, basis down. Annual adjustment for basis, like I said, contributions in, cash in, shareholders' ordinary income, cash out, and cash in. It's basically income in. So that's going to increase your stuff. Distributions, cash out, shareholders' share of non-deductible expenses, that's also going to decrease. So, for example, if your company gets fined, $10,000 for doing something stupid, more likely than not, what'll end up happening is that that's going to be a reduction in basis, but you didn't, even though you don't get to deduct it, because the IRS basically says you still had an economic effect of that. So the base is going to reflect that. Shareholders' ordinary business losses are also going to reduce it. Now, remember, basis can never be to zero. You might say, well, wait a minute, if we've got an NOL, can't I go below zero? And the answer is you can, but it's not. But your basis isn't going to go below zero. You're going to have the NOL carry forward, but that's going to get you back to zero. Now, does that mean that if I have a loss that I have a taxable event to me, the shareholder, because I have losses in excess of basis? The answer is no. But if I take a distribution and I have zero basis, that is going to be a distribution in excess of basis subject to capital gains rates. I actually have a client who's dealing with that right now. They closed their partnership, and it's similar to this, but in the year that she closed everything out, they took an amount of cash out, and because the previous CPA didn't keep up track of their basis, we're actually trying to get that recalculated so that we can figure out what's going on. But anyways, that's kind of what it is. So this is going to be, loss limitations. We've talked about this in the past with the other parts, the partnership returns. There's a tax basis limitation. The loss recognition rule almost exactly follows the way partnerships does. First of all, you got a tax basis limitation, then you have an at-risk basis limitation, and then you have you also have a passive limitation. All that still applies. So, the at-risk limitation, same thing. Again, Code Section 465 for us here. That's going to talk about, that the only to the extent of their at-risk limit. Shareholders are deemed only at risk for direct loans they make to the corporation. Again, that's the cool thing about this is there's no more recourse loan, non-recourse loan. None of that crap doesn't apply anymore here. Unless you loan money directly to the corporation, you're not going to have to worry about any of that stuff, okay? This is sort of a, some examples I'm going to post, so they do talk, so Code Section 1366, I've personally never dealt with this before. I was asked about this once, so I actually did some research on this question. But it's post-termination transition period loss limitation. Allow shareholders to treat suspended losses existing at the S corporation's last date of the PPT. A rule allows to create stock basis by capital contributions during PTP to utilize. So in other words, say for example, if I have losses of $50,000 that I can't get out of an S corporation, because what happens is, maybe it's just, there's a basis issue. There's a period of time that you're given that they will allow you to basically put that $50,000 back in the company. In exchange, you get a reduction. Now, my personal opinion is this doesn't make good tax sense. Because if you think about it, yeah, I lose a $50,000 loss, which means I don't get a reduction in tax, but it's going to cost me $50,000 to get a reduction of tax that might be at marginal rates of 24%. That doesn't make sense to me. Now, you may be obligated to do this. We may put that in the operating agreement that says, look, if we dissolve the organization and we find out, and it comes to the realization that you have a negative basis, we're allowed to come back to you and take that cash. You may have an obligation to that because what happened is that you took out too much cash from the company. These don't happen very often, and like I said, I've only had one time where somebody's even asked me about it, and I did some research, kind of just as I wasn't doing a whole lot at the time, and I said, look, You want me to research that for you? I'll find the answer out for you. And it actually helped me develop a really good relationship with this one guy. So I ended up dealing with that stuff. Okay, so then you have PALs, passive activity loss, PAL limitations. No different than a partnership. Okay. There is this excessive business loss. That is still in appliance also at this point, because it works partnerships, S corps, C corps, Schedule Cs. It's the excess business loss. They're not going to let you take the whole thing up to a certain point. Self-employment income. This is the biggest difference between partnerships and S corps. S corporation shareholders' allocable share of ordinary business income is not classified as self-employment income. In other words, no 15.3% sales self-employment tax. Shareholder salary as an employee is subject to Social Security taxes. This is where the IRS kind of comes back, and they decided that look, you work for the corporation, fair market value of services that you put into the corporation, you must be compensated for. Okay, so as a manager of this organization, there's a certain amount of money that I'm supposed to be paying myself. Now, there's a whole lot of facts and circumstances that go into figuring out that number. The number one thing is, what's the value of what you're putting in? So last time I worked at a Big Four, I was making about $110,000, $115,000 a year as a low level, as a high level senior. I was overpaid, to be honest. I think it was because of my qualifications. Because most of the time managers in my group were usually managers at the Big Four. You don't hit six figures till you make manager minimum. And usually you're going to be a manager for about a year or two before that happens. I was actually, because of my skill set, I was actually brought in a little higher. But what happened is that, so technically the IRS could come out and say, hey, look, fair market value of what you provided to this other organization, you're doing the same thing here, $110,000 a year is what you're supposed to be paying yourself. Well, yeah, that may be true, but there's going to be certain circumstances where I'm going to say, look, that was at a Big Four. This is a smaller firm. So they're going to go to smaller firms. What does managers at smaller firms make? Maybe they only make $80,000, $90,000 a year. And so as a result of which, you're going to have to break yourself down. And so on and so forth. So there's going to be a whole lot of facts and circumstances. The other thing that's going to be a facts and circumstance, how much money is the company making? Beta, as a small business, the profit margin for Beta is pretty low. Now, the reason why it's pretty low is I keep throwing money into these various options to grow my business. I spend an exorbitant amount of money on advertising. I mean, if I just cut advertising altogether, I probably would be, I'd probably be living La Vida Loca here. But the fact of the matter is I'm trying to grow the business. So I spend a lot of money doing that. So the IRS isn't going to come back to me and say, you must pay yourself $100,000 a year. And I'm just going to throw a number out here. I actually haven't done my taxes for this year because, of course, the CPA is always the one to do his last tax on himself. But say I made $70,000 this year. They're not going to tell me I got to pay myself $100,000 on $70,000 of income. That's just ludicrous. So the IRS is probably going to give me a waiver on a lot of this stuff. Now, if Beta's making $400,000, $500,000 a year in taxes, in taxable income, and I'm not paying myself anything, they're going to come after me. I mean, it's a foregone conclusion. They're going to come after me. So once the corporation makes a certain amount of money, I have to pay myself at fair market wages. And there's tax planning incentives here. And the last law actually made it even worse, because any money that I take as salary does not qualify for the QBID, the qualified business income deduction. I don't qualify for it. So if I say for example, I make $100,000 and I pay myself $100,000 in salary, I don't get any of the QBID for that. My QBID would be zero because I would be 100% paid out. But more importantly, I'm going to pay Social Security tax on that $100,000. So it's a double whammy there. So there's a huge incentive for people not to pay themselves fair market wages in order to be able to qualify for more QBID. And so the IRS will, I anticipate in the next few years, you're going to be seeing more and more people getting hit with this as we kind of talk a little bit about it. Now I will not lie to you. I actually break this up to clients and say, you're a partnership. Why are you a partnership? You should be an S corporation. If you're an S corporation, this thing would actually go much smoother. and it would allow you to alleviate a lot of your self-employment income that you have. Okay, fair enough. So we'll go ahead and we'll take care of that. But, again, it's something that sometimes we end up having to deal with, and all that. So it does get to be a little bit of a conundrum dealing with a lot of that stuff. So, net investment income tax. Okay, so if you are a passive investor in an S corporation, you will be subject to the 3.8% income tax. The thought process here is that if you're not actively participating in the work of the organization, you're just putting money in because you think somebody's got a brilliant idea. You don't do a whole lot of substantial services for that, as a result of which it's passive income to you. That is generally going to be seen as a 3.8%. Now, it doesn't necessarily have to be passive, but the question of the day is, if you are, if the organization, if your enrollment in the organization is primarily as an investor, now you could go in, you could, periodically, maybe on like Saturdays, offer to cover the desk shift for one time. That's not going to necessarily trigger this to go. And again, it's all facts and circumstances. All right, common types of investment income. Oh yeah, but that said, and actually I'm glad that they brought the second bullet point up. That said, so if the S corporation in and of itself makes net investment income. So for example, I have a corporation. Say I decide I'm gonna form a a Merrill Lynch account where I'm going to take excess cash and I'm going to go ahead and invest it in the market. Well, if I do that, which is all well and good, that's going to have dividends, interest, and royalties and rents and all that sort of stuff. All that stuff is going to be subject to the NIT on my personal tax return. So it will increase all of that. And here's the thing: this isn't something you're going to have to calculate on your own. But what's going to happen is you're going to put the K1 into the tax system, and it's going to go over there, and your NIT's going to go up as a result of some of this stuff. Now, there may be some times where your S corporation holders maybe weren't paying attention to their tax returns in the past, and all of a sudden they see this other tax for $1,000, and they're like, "What the hell is that?" And you're like, "Well, you had a whole bunch of net investment income from your S corp." They're like, "Wow, I never noticed that before." And you go and you show it to them in their previous 3 years worth of tax return, and they've had it every year. They just never noticed it. This is what I like to call this sometimes I call it the Klingon tax, because it's got a cloaking device that nobody really pays attention till all of a sudden it decloaks and then it shoots you. And for you non-Star Trek fans, which, I'm sorry to say there's probably more of you guys than I would like to admit, you probably don't get the Klingon reference. But the fact of the matter is that it can be sneaky for some people, and then all of a sudden one year it hits them pretty hard. Fringe benefits for shareholders who own 2% or less. The S corporation treats them as a non-shareholder. Okay, so say for example I own 1% of an S corporation, but they also hire me for $100,000 a year as an employee. I am treated as an employee as a regular corporation. And the thought process of this is usually 2% or more shareholders usually are exercising more control. Now, why do they use 2% instead of, say, 10%? I don't know. My personal opinion is, the 2% is rather arbitrary. But the fact of the matter is, what they don't want to have happen is people are setting up S corporations to get around the whole C corporation thing and then doing the whole taxable or tax-free fringe benefits. Again, so if I'm a 1% shareholder, they pay me health insurance. I'm treated as it coming from a C corporation instead of an S corporation, which means it shows up in my W-2. I don't pay any taxes on it. It comes right off the top. I don't have to deal with any of that stuff. Now, if I'm a more than 2% shareholder, I'm treated as a partner for fringe benefits, which means it has to show up in my K-1 as taxable income, which then I get to take a tax deduction on the front page of the tax return. Ends up being a wash in most cases for some stuff, but in some stuff it won't be a wash. So, for example, education benefits. If the corporation pays for part of my education benefits, that's taxable income to me through my K-1. There's nothing I can do. Okay. Operating distributions. So if you have no E&P, distributions are tax-free to the extent of shareholder. Now, what does it mean by E&P? E&P is earnings and profits that you would see, and normally earnings and profits are only associated with C corporations. Now, one major difference. If I had a C corporation that eventually, say I was a C corporation for 20 years, And then I go ahead and I say, okay, well, I want to elect S corporation status. So you elect S corporation status. I'm going to go to my accumulated earnings and profits, my AE&P, and I notice I've got $1 million. The IRS, under their rules, requires that I have to distribute $1 million. That $1 million of E&P must be distributed prior to me getting tax-free treatment on the distributions going forward. And that's what they're kind of talking about here. And so, basically what they're trying to do is they're trying to say, don't build up this huge amount of cash, elect S status, and then all of a sudden think you're going to be able to take everything out tax-free. That's not the way this works. It's tax-deferred, but at the same time, going forward, if you do have accumulated earnings and profits, you will have to take it out of distributions first. Distributions will have to come out of E&P first before you get the tax-free stuff. Now, if you elect S status from day one, this isn't a problem because you don't have any E&P because you never had any earnings and profits before this happened. So that's going to be an important thing there. All right. So corporations with E&P, so you have distributions from AAA. AAA is your accumulated, accumulated, oh God, I can't remember what the third A, I'm having a brain fart here. Gosh, anyways, it's the account that we actually monitor. It's basically, it works a lot like retained earnings. There's a few differences, but it's kind of like that. Again, it comes from your AAA, then E&P, and then any amount from the shareholder basis. Distributions from AAA are non-taxable to the extent of shareholder basis. Any excess is capital gain. We have to track AAA. It's actually, there's a really neat worksheet. I don't have access to it right now. I wanted to see if I could find it. And I was going to see, because I remember downloading this, a couple years ago. I was going to try to see if I could find a copy of it when I had it. And let's see if I can do that right now. Let's see, text research. No, I'm gonna see if I can find it real quick. If I can't, I'll try in 2 locations. If I don't find it in the 2 locations, let's see. No, that's not what it is. Never mind. Okay, I thought I might have found it, but anyways, there's actually a really neat worksheet that Thomson Reuters put together that tries to figure out, and there's actually 3 different types of accounts. You've got AAA, OAA, and that's the other accumulated. Okay, I'm sorry. Accumulated Adjustments Account. That's what it stands for. I know, like I said, I was having a brain fart. So Accumulated Adjustment Account is what AAA stands for. OAA stands for Other Adjustments Account. And then there's also your E&P is going to be your third one. Now, generally, everything goes through AAA. Now, there's a few things that don't. So, for example, if you have life insurance on key members, that doesn't go through your AAA as an expense. It goes through your OAA because you can't take distributions based off of how much you paid for your accumulated through your life insurance stuff. That's a very common one. Actually, it's one that I ended up getting to a huge argument with one of my partners. Turned out that she had been miscalculating things for almost 15 years because she kept putting insurance into this AAA account. When I brought it to her attention, I was no longer her friend. And to this day, I still love telling you the C story. But anyways, so distributions from AAA are non-taxable again. Distributions from E&P are taxable as dividends. Again, E&P can only exist if you were a prior C corporation. You don't have to worry about it otherwise. Distributions of shareholder basis are non-taxable to the extent of basis. Any excess is capital gains. And again, how long you've owned the corporation determines the life of the gain. AAA calculation, we're not going to talk too much about this. Like I said, it generally works similar to retained earnings per partner, but what's going to end up happening is you got tax exempt income plus ordinary income minus separately stated losses, ordinary losses, blah blah. Distributions out of AAA is the end of year AAA balance. Again, generally they're going to calculate this for you. The only time that this really becomes a problem, though, is usually when you're talking about distributions in excess of AAA. If the company's not been doing very well, this could actually become a bit of a problem, because you may be paying distributions when you weren't entitled to. Generally, if it's just a single member owner, this isn't going to be that much of an issue. The time where you're going to really have a problem is when you've got multiple owners, and the AAA doesn't get calculated correctly. At that point, usually what'll happen is if the client's paying for it and we've got multiple owners, we'll generally do a AAA calculator that we do. Most of my clients won't pay for it, so I don't do this for them. But if they ever get into trouble with it, they're going to be paying me for it, and they're going to be paying me at elevated rates because that's kind of the way we do things. They want to save money now, that's fine. If they need it later on, they'll pay out the wazoo. So this is an operating distribution. They do a distribution, and this is how they kind of calculate it out. Again, this is something that ends up happening. Again, there's this, CC's E&P balance can only happen if they were a C corporation. Okay. Property distributions. Usually, one of the biggest problems that we have with S corporations is usually when they talk about property distribution. When I say property distribution, I mean something other than the cash. So if I have a piece of land, I'm going to do a distribution. I'm going to give a piece of land to my shareholder instead of cash. The shareholder is going to recognize, distributive share and deem gain and increase in their stock basis accordingly. Again, the S corporation is going to recognize gain on the distribution. This is why this is ugly. We usually don't recommend clients to do this, but sometimes clients are going to do what clients are going to do. And, we'll do the work for them, but again, they're going to probably end up paying some tax on it. Usually, when I tell them, it's kind of like when I say you shouldn't do this. For those of you guys who are Ghostbusters fans, it's like Egon Spangler when he says that would be bad. And for those of you who don't know, Ghostbusters was a movie in the 80s, and anytime Egon Spangler was kind of the nerd of the group who was, but the biggest brain person. And so when he puts out something that's bad, usually we're talking like end of the world bad, And, I remember, sometimes we're talking to clients, oh, I don't think I'd do that. That'd be bad. And I had one client who once told me, and he said, Egon Spangler bad? And I'm like, no, the world will still exist afterwards, but you're not going to like it. And when I talked to him through the whole process of it, he's like, yeah, you're right. That's bad. So sometimes we tell our clients, I don't recommend doing that. That's not what I would do, blah, blah, blah. All right. We're not going to talk about liquidating distributions. Just see if there's anything else. Built-in gains. This is something to kind of take a look at. Again, if you have built-in gains when you actually do it, there is actually and this sometimes gets set up. They don't mention it here. Oh yeah, they do. Okay, so during the first 5 years of this as an S corporation. So if you have somebody that's contributed at a built-in gain, they hold it for at least 5 years or more. There's no built-in gain problems that you would normally have. Estimated taxes. Yes, generally C corporation follows C corporation rules. The problem is though, the person who has to pay the estimated taxes is not the corporation, it's the person. And so that's something that you'll have to do. Normally distributions are done in order to handle that. These are some differences and in considerations. My recommendation, if I were you guys, I would take these slides that you have here and keep them in your little crib sheet notes that you can refer to whenever you're doing taxes. I actually stole some of these slides from my business. I found them that useful. So it's actually pretty good in that sense. All right. That's all I got to say about that. Guys, I will, is there any questions about anything prior to us adjourning for today?